So, very happy to introduce our fourth panel. We're going to try and move on a slightly accelerated schedule here to get done by noon. My name is Eric Durbin. I'm an economist in the Consumer Financial Protection Bureau. And I'm very excited to introduce this panel. We have 4 papers, each of which looks at how consumers make decisions about financial products and, to varying degrees, how information affects those decisions. So we'll go ahead and introduce our first presenter. Ryan McDevitt is a professor at Fuqua School of Business at Duke University. He's going to present the elasticity of demand for alternative financial services, evidence from check cashing price changes in the South Bronx. Oh. If you can...
Okay. This is joint work with Aaron Sojourner. He's at University of Minnesota Carlson School of Management. Our paper and our research agenda looks at, which I think is an overlooked corner of the financial services market, check cashing. And at the core of our research, we're going to exploit a price cut at the bank we receive data from. And that allows us to do some interesting things, to look at some interesting parameters for this segment of the population. Mainly, we're going to explore how sensitive these customers are to price. It turns out they're going to be very price sensitive. Right? In fact, they're almost 6 times more sensitive to price than they are to travel costs. And we're also going to look at how much withholding time for a check to clear affects their decision to use mainstream banking versus check cashing. Right? So those are 2 key parameters we look at with our analysis. And we're going to use these parameter estimates to evaluate the policies that are on the books right now. Most states regulate check cashing, both in terms of fees and locations. We're going to recommend, based on our findings, that we should give check cashers actually larger protected territories, but lower check cashing fees, because consumers would find that much more beneficial. But another large impact for this population would be accelerating check clearing times if the goal is to move people away from alternative financial services and towards mainstream banking. Right? One of the key restrictions on that for consumers is that they have to wait too long for their checks to clear. Accelerating check clearing times would have a large impact on consumer welfare. Okay? So just a brief background on check cashing for this audience. Essentially, if you have a paper check but don't have a bank account, or you have a bank account but you want a more convenient financial service, you take your check to a check casher. They can convert it to cash for a fee. Right? And these turn out to be pretty high fee services. Right? So one way to look at this, if you pay a 2% fee in a $1,000 check to avoid a 2-day hold on your check clearing, right, that works out to be about a 4,000% APR. Right? You don't usually think of that in those terms because it's not a loan product. Right? But if you get a 2% return over 2 days, do that over a whole course of a year, hedge funds would find that very attractive. Right? That's a big return. Right? And this affects a large segment of the population. 17 million, almost 1 in 10 households don't have a bank account, right? And 40% still receive paper checks. Right? So this is a huge impact on this segment of the population. Okay? Again, because this in many ways serves a kind of vulnerable population, right? It's heavily regulated, including the CFPB is now regulating check cashing. States are also involved with this. We'll look specifically at New York, and they have 2 key regulations on the books. One, they have a cap on check cashing fees. Right now it's at 2.01%. And the lobbyists did their job well in this case. They've actually indexed the rate to inflation, right? Meaning if you have a check, that nominal face value should go up each year for inflation, especially something like a Social Security check, which is explicitly indexed each year for inflation. But they're getting inflation on the rate of that, right? So they're getting double inflation. They also restrict entry for check cashers to within 0.3 of a mile of an incumbent check casher, right? So you can stare at this and puzzle over these regulations are working at cross purposes. The fee cap helps consumers, keeps rates down. The entry restriction helps firms, keeps rates up. I guess on average, everyone's a little dissatisfied. No previous work in this area, though, has looked at these regulations and evaluated them using check cashing transaction data. Right, so that's going to be one of our key contributions. Previous work in economics in this area mostly is done for payday lending, right? And they're puzzled over the fact that people are using these very high fee, high cost financial services when there are cheaper alternatives available. And some of the explanations studied already, this is a population that has key liquidity constraints. They're living paycheck to paycheck, so they value easier access to cash. There could be lack of alternatives. They can't access a bank account because they've had misconduct in the past, or they're just trying to hide their financial transactions. There could be a lack of trust in the mainstream financial system, or there could be a behavioral component. Right? They just don't understand what these fees represent. Okay? We'll be able to say something about points 1 and 4 in our current work. Points 2 and 3, hopefully we can work on later in the future. So the setting we look at specifically is Spring Bank, a bank that opened in the South Bronx, New York in 2008. This is an area of New York that's underserved by mainstream financial services, very few full-service bank branches in the area. This bank is unique in the sense that they have a stated mission to serve the underbanked community, right? So they're willing to take a hit on profits if they feel like they're doing good work for the community. And they, in the process of doing that, offer a mix of financial services beyond just traditional banking, specifically check cashing. So they'll cash checks or sell money orders to people who don't have bank accounts at that bank. Aaron is on the board of directors at Spring Bank, and that's how we became involved in this project. So the market specifically, you can look at this map of the area around it. As a point of reference, Yankee Stadium is there in the bottom corner. Right, so this is an area of the Bronx that has a large minority population. 75% have no discretionary income. 50% don't have a bank account. Right, and there are very few full-service banks in this area. Its rate is 1 in 20,000, and this compared to 1 in 3,000 for Manhattan. Right? So I think this is a very underserved segment of the market. The 5 nearest competitors, which are the red dots, all charge a state cap for check cashing. And in fact, in our surveys, our evidence, it's almost universally true in New York that every check casher charges a state cap. So Spring Bank has taken a different approach to pricing. They started like everyone else in 2008 charging at the cap, which was 1.75% that year. But then each February, when the state reindexes the rate, Spring Bank kept their rate at 1.75%, while competitors went up to 1.82, 1.83, 1.86 in 2011. Now, as the rate goes up each year, as an economist, you think this might be enough price variation to estimate some kind of demand curve. Right? But in practice, the differences are too small to actually gain any traction in that sense. It's hard to imagine someone with a $500 check going all over the city trying to save 80 cents. So when you try to estimate a demand curve, it's really hopeless in that way. Which should give us pause because New York is regulating check cashing fees, and you would think at the core of that regulation should be some idea of consumer welfare, which is impossible to estimate if you don't have a sense of the elasticity of demand or a demand curve. Right? So they're flying blind in that case. But in 2012, Spring Bank introduced a dramatic price cut. The new policy would be $1 for checks up to $1,000, and 1% for all checks greater than $1,000. Right, where all the competitors were now charging 1.91%. In a plot of this fee schedule, you can see there's a dramatic difference now between Spring Bank and the rest of the market. And as an applied microeconomist, you really love to see a price schedule like this, where there's sharp discontinuity right at $1,000. So on the left-hand side of that threshold, prices went from a $1,000 check for $17.50 down to $1, a 94% drop. On the right-hand side, still a large drop, 43%, but not as severe as the left-hand side. Right, so there's a nice regression discontinuity design available for us. Right, and it's exactly what we'd expect the intuition would hold here. Consumers responded more on the left-hand side where the price drop is greater, up 69%. On the right-hand side, 25%. Right? This is going to be the foundation of our identification strategy. In 2014, Spring Bank changed its prices again, took some of that price savings back. Now it'll be 1% for all checks for non-account holders, $1 for account holders with at least $100 in their bank account. Right? They wanted to grandfather in the account holders because they're so distrustful of banks as it is, they didn't want to feel like they were being exploited with a bait and switch. And here now we have enough price variation, extensive price variation, to estimate a nice looking downward sloping demand curve. And here's how we can now benchmark the elasticity of demand for this population and start to evaluate the policies that are in place. So our model, looking at the micro data, is very simple, straightforward. It's a basic latent utility model. We'll use this as a logit, 1, 0. 1 being if you cash a check at Spring Bank, 0 if you go somewhere else. The data we use from the bank, we have a customer ID that's anonymized by the bank to respect their privacy. The date of the transaction, the fee, face value of the check, how far the customers are from Spring Bank, how far they are from those 5 nearest check cashers that we showed you, and if they have a deposit account with Spring Bank. In some cases, we'll have to infer data because we don't see what these customers do if they don't come to Spring Bank. So we'll assume they go to the nearest check casher to them and cash their check at the state cap, whatever that is at the time. And for customers who we don't see before the price cut, we'll assume they get the same stream of checks they have in the post-cut period, and they're cashing those at the state cap. Okay. Our identification here is pretty clean as far as we're concerned. Price, because we had that sharp discontinuity in the price schedule, and it varies considerably over the time of our panel, right? Identification is just coming from differences in price for consumers are facing when they go to cash their check. So someone with a $1,000 check, the unobserved characteristics of that transaction should remain constant. It's only the price that's varying throughout our period. And for distance, we think of customers as being randomly populated throughout the area, but as they see greater fee savings and they're becoming more likely to come to Spring Bank, right, that's how we estimate their willingness to travel. Okay. To give you some context from the data, we see the price cut was very effective in the sense that number of checks cashed at Spring Bank more than doubled before and after the cut. Right? But unfortunately for Spring Bank, the total fees they brought in fell by half. Right? This was such a severe price cut, they started losing money on this promotion. Okay? Customers went up by about 50%, and a large chunk of that is check cashing customers with deposit accounts who are now willing to cash their check for such a small fee, $1 in most cases, whereas they were depositing it before and paying no fee. So we'll come back to that, but there's a lot of cannibalization across depositing and check cashing depending on the fees, which is going to have a nice policy component to it. For estimation, we should think of the average check as being about $500. Customers coming to Spring Bank save about $3, and they travel an extra 1/10 of a mile to come to Spring Bank over a competitor. And so here's one of the, we do many regressions in the paper, but here's the benchmark regression. Again, the easiest way to interpret this is look at the elasticity. Customers are have a velocity of about 6 for cashing a check in terms of fees. So 1% change in price leads to a 6% change in demand. They're actually less responsive for traveling. Right? They're much more willing to travel to save a fee. Then they care more about that than the distance. Okay. Right. We estimate based on those price coefficients and travel coefficients that they're indifferent between saving $2 or traveling an extra mile. Right? And that seems to be a very low number for us. In America, it's hard to imagine someone traveling an extra mile for $2. Right? But that's how much they care about saving fees in this case. They have more time than they do money. More distant customers, more price sensitive, which we think is intuitive. Customers with deposit accounts are less price sensitive. Wealthier customers, more sensitive to distance and price. And frequent customers are very price sensitive. Okay? So for Spring Bank, I'll show you, I alluded to this already. Volume doubled. Fees fell by half. So if you teach MBAs like I do, this is the kind of chart you show and smack your head and say, you never want to see this for a business. Right? They're way on the inelastic portion of the demand curve when they cut their prices, which begs the question, what should they be charging if they want to maximize revenue? So we estimate that in about the 1.6% range, which then leads to the next question. If the optimal fee is below the state cap of 2%, why do we observe every other check casher charging 2%? So as an IO economist, we think maybe there's something going on in terms of collusion, implicit or otherwise. There's a topic that we haven't studied in this paper, but that's our next topic on our research agenda. If people in this room are interested in it as well, I'd love to chat with you after this. I think it's a very provocative finding. So the last key component of our paper, we look at customers who have a deposit account at Spring Bank, and they're deciding between cashing and depositing a check, right? And about 1/6 of the time, they opt to cash a check, right? They have a free alternative, but the decision now is, do we wait a day or two for the check to clear, or do we get our cash immediately and pay a small fee? Right? You see customers are very responsive to this check clearing time, especially if you look at the low-income population. And low income should be in quotation marks, right? Because this is a $20,000 income threshold, so I wouldn't characterize that normally as high income, but for this population it is. Right? For the low-income group, they cash about 1/3 of their checks instead of depositing it if they have to wait 4 days for it to clear. So here are the elasticities. $1, 2.4% more likely to cash a check, but 1 day extra holding time leads to a 12.9% increase in cash and checks. Okay? So I'm out of time. I'll wrap it up there. We look at 2 policies. We show that the state should relax the entry restriction, but lower the fees even further. That would have a large impact on consumer welfare. And because consumers, we show, are willing to pay $5 to avoid an extra day of holding time, that works out to be a 520% APR. Right, so it'd be huge welfare gains from accelerating check clearing times. Okay, thank you.
Next, we have Vincent Yao from Fannie Mae, where he's Director of Credit Portfolio Management. He's going to tell us about systematic mistakes of borrowers in the mortgage markets.
Oh, I have to repeat it one more time. So first I want to thank the CFPB conference organizer for putting such a high-focused, high-quality conference together. And given how consumer behavior has been so important either during and after financial crisis. And I also want to say, like, this is really fortunate for our generation, you know, to kind of actually to observe so many different behavior and actually can engage, you know, very interesting research in an interesting time. So this is a joint research with Sumit and Azahi. They cannot make it here. Before I start, I want to read that legal disclaimer really loud. So the views here, you know, only reflect me, my co-authors, doesn't reflect Fannie Mae and any other institution. I especially want to mention our regulator, FHFA, and also the organizer of the conference. Motivation. Very simple, right? So there are lots of mounting evidence, you know, talking about the financial decisions households make, mostly in the equity market, you know, largely done by John Campbell and his co-authors. Lots of high-quality papers. But, you know, to date, there's very limited evidence, actually, about optimality of the mortgage decisions. There are a few papers there, but, you know, there are lots of work that can be done that would, you know, shed light lots of decision-making about consumer financial protection. And the other motivation, obviously, is what Chris actually challenged us yesterday, right? He asked us, like, you know, to define what is the optimal decision. It turned out from our experience, like, you know, it is very, very challenging, very hard, actually, to define optimal behavior and trying to evaluate that. We have run lots of brain cells in the past, you know, 4 years, just trying to actually finish this paper. And I want to apologize to our discussant if you do see any inconsistencies between the version you have read and you know, the slides you see here, because we're constantly making changes given how challenging this topic is. Before I talk about the points, I really want to do a simple survey here. How many actually in the audience, you know, have taking a point. Any point. 2, 3. So basically, either you have a considered point or you have never considered point. We actually, in this paper, we can identify 2 types of mistake. Among the people who took a point and among the people who did not take a point. Either way, you might actually make a mistake. Given basically, the background of people in the audience, hopefully, you have not made a mistake yet. So what are the points? Very simple, right? Points basically is upfront payment as a percentage of your loan balance in exchange for the reduction of the interest in the future, right? And, like this 1% of UPB, we call it 1 point. If it's 2%, we call it 2 points, right? And how are points valued, right? If you think about points, you actually have, similar, instruments or financial products elsewhere, such as like at origination, lender kind of offer points to the borrower. Then during the securitization, right, lender also trade the points, so-called like interest-only strips with the securitizers, right? If they want to return more IO, they're going to buy down the yields from the securitizer. We call it buy down. If they want to actually sell IO, they need to basically increase the IO to the securitizer. We call it buy up, right? So you have a buy on, buy down process, which is the core process of a securitization. At the same time, right, in the secondary market, you also have very liquid derivatives that basically is securitizing all the IO strips, such as synthetic IO. So there's a very liquid market here that measures the value of IO securities, similar to the point. Another one I want to mention is basically mortgage servicing rights, right? MSR. MSR is also a point. Today, right, it's a very volatile market. So basically the points and the likewise, the IO securities, they are valued in multiples. So if a multiple is 4, means actually 1 point would actually exchange like 25 bips of reduction in interest rate. Other words, basically, in order to get a 1% interest reduction, you need to pay 4% up front, right? So look at it here, basically, the points, basically, cash flow, you have a negative cash flow in time period 0, then you have positive cash flow in time 1 through capital T. The challenge here is that the capital T is unknown to the investor, to the borrower at the origination. So that's a big, first challenge we need to deal with when we're trying to evaluate the points decision. Secondly is basically different borrower, they have a different opportunity cost, right? So if the borrower actually keep on the mortgage for 4 multiples, which eventually suggests that their internal rate of return is 0. But in reality, right, the borrower requires more than 0 IRR. So that's our second challenge here. The approach actually we use to evaluate the points is actually a little complicated here. Is the first one, you given the multiples the borrower paid to buy the point, then we consider individual specific opportunity cost. Eventually we come up with the minimum years that the borrower need to stay on the mortgage in order to recoup the investment they put up front. That's the number 1 step. Second one is we go back to the data, right? We try to estimate expected tenure this borrower expect to stay on the mortgage at the time of origination. Then we compare these 2. If the expected tenure is longer than this minimum tenure, we basically say borrower make a good decision because they expect to basically stay in the house longer than multiple, right? They expect to recoup all the interest, the savings they expect to receive. Otherwise, it's probably not optimal decision here. Data, very typical, prime, conforming, and conventional mortgages from 2001 to 2011, right? And where we actually have the points data available, right? This is also you also have the very standard mortgage attributes, right? You have also the payment history. You also have, the home price, used for market-to-market LTV. You also have interest rate that you use to calculate interest savings in order to evaluate their ex post decision. Then the most important one is basically we capture the points from a hard-won form. That's required by the hard. The final sample basically contains about a little bit over 300,000 loans and a little fewer than 5 million loan quarter panel data. Ex-ante analysis is just exactly what I said, right? First step is we estimate the minimum tenure. Then second step we use proportional hazard to estimate ex-ante tenure. We actually classify the borrower into two groups. Type 1 error is basically people who did not take points, and they should take points. Type 2 is actually they took points, but they should not, right? So basically, we can identify these two types of mistake. They also take a look at who are these people, what type of a profile they have, and eventually trying to identify what kind of consumer you actually need to protect or to help. Second approach we take to evaluate the points is actually very simple, but it's not actually applicable to most of borrowers, right? Here, like, most of the people in the room, you do know the mortgage pricing decisions, either at the bank, PMI company, GSEs, or everywhere. It's really like, stepwise, like, increase along the LTV knots, right? Which means actually, once you reach 80, right? So everything else being equal, all the companies would give you flat price, for LTV between 80.01 to 85. Then another jump from 85.01 to 90. Another jump from 90.01 to 95. So prices relatively like, flat, in this range. So, we actually can kind of quantify the opportunity cost of the points. Instead of paying down, the interest rate, you could use the same amount of money, trying to move your LTV from the current, the level to the next level. So immediately you get a big reduction of the points. So this is however, if you are able to, use that amount of money, that investment to lower your LTV, your perceived, right, opportunity cost or benefits would be much bigger than the interest reduction you receive from the points. So this is our second approach to evaluate basically the points decision. Then ex post, we're trying to evaluate like, given like you pay the points at origination, does this decision really affect your future decisions, right? Including like default, move, refi, all these decisions. If they do, right, basically this kind of actually justifies sunk cost fallacy, right? Then like, we basically have the evidence that borrowers who pay the points at origination has, basically, small likelihood to refinance after the origination. And the magnitude is actually pretty significant, right? If you basically do not control for interest saving, that's about a 10% slower hazard of refi. If you control for interest savings, right, basically we can separate the two, right? Interest rate itself basically increased the hazard by 63%. But for people who actually pay the points at origination, that refi has actually reduced by 47%, almost offset basically the refi incentive from the interest savings. To close, so we basically conduct like, we document basically what kind of people who pay the points, we compare the profile, then like the second is we try to evaluate the points decision ex post at origination, given the information available to the borrower back then. We use the two approach to identify like, the ex post point decision. Both types actually can identify like, different mistakes here. And like, for the type 1 error, for the people who actually did not pick the points, but they should take a point, we identify these are usually the people with high FICO and high LTV, meaning that they are financially sophisticated, but at the same time, they don't have the liquidity to pay extra points. For the type 2 error, people are usually the people who actually with low FICO, less financial sophisticated borrower, which need lots of help. Then we also take a look at the ex post decision impact of a points decision at origination. And we basically confirm that, points decision at origination slow down people's like, refi decisions, very significantly. That's the end of my presentation. Thank you.
Next presenter is Jonathan Zinman. He's a professor of economics at Dartmouth College, and he's going to tell us about unshrouding effects on demand for a costly add-on, evidence from bank overdrafts in Turkey.
Great, thanks. It's extremely gratifying to me to be here at this conference with you all. I'm also very grateful to my co-authors, Dean Carlin, my frequent collaborator, and also Shula and Mehmet. This is a paper about direct marketing field experiments conducted with a large commercial bank in Turkey. And as far as this project goes, the counterfactual is clear. No Shula and no Mehmet and no project and no paper. This is a rare case where we don't need a field experiment to pin down the counterfactual, and so very grateful to them. As I said, I'll be telling you about the results of a direct marketing field experiment done by this bank, marketing its costly overdraft product. First, let me give you sort of the academic motivation for what we are approaching here in terms of research questions. So many of us behavioralists, thanks to the work of Yapi Kredi and David Leibson and others recently in their wake, have come to think about products like bank overdrafts as a costly add-on. And so what do we mean by that? What we mean is there's a base good that is often marketed and offered quite cheaply. Think, quote unquote, free checking, right? There are one or more costly add-ons attached to that base good. In this case, the add-on we're interested in is the fee or the high interest rate you pay in the event, in the contingency that you go into the red in your bank account, in the event that you overdraft. And so behavioral economists and, of course, policymakers have become very interested in recent years in whether this kind of tied add-on pricing, when the base good and the add-on feature of the good are offered by the same suppliers, whether these arrangements might end up being deceptive and or inefficient. All right, and so some causes for concern, some symptoms, but far from proof that we should be worried about such things is that add-ons, overdrafts in particular, have tended to be priced very expensively in various markets around the world. Regulators have responded by acting to constrain the behavior of banks in these markets in various ways. And overdraft markets have come to be quite economically important, both as a profit center for banks and as an out-of-pocket expense for certain bank customers, at least. All right. Theoretically speaking, the models and types of models we are interested in, if not exactly testing for reasons that hopefully I'll get into, but at least speaking to in our empirical work here are models of shrouded equilibria. How do we, so a characteristic of bank overdrafts and how they are marketed across the world is that they tend not to be featured in marketing. That's what we mean by an add-on being shrouded. This is not bank overdrafts. There's lots of descriptive evidence suggesting that when people sign up for or shop for, if they're shopping for checking accounts, are not necessarily considering bank overdrafts as a feature of the product they are getting, nor are they considering how much it might end up costing them to overdraft if they end up in that state of the world. There are also models of various aspects of consumer attention or inattention to add-ons. We're going to be speaking to these questions. So let me say a little bit more descriptively about why we think these questions are interesting. I already talked about marketing practices. There are downstream practices that give one pause in the overdraft market as well. Banks often blur the lines between positive and negative balances in many markets around the world by reporting available to withdraw amounts that are the sum of the consumer's balance and available overdraft credit. Right? So this happens in many markets, or has happened in many markets around the world, and was happening in Turkey at the time we did this experiment. Overdrafts also happen passively, automatically for consumers, in contrast to other loan markets. It's even passive compared to say a credit card transaction. The overdraft happens automatically as a consequence of me making a purchase, that stands certainly in sharp contrast to taking out an installment loan, even like a payday loan, for example. And there are various types of descriptive evidence, including some evidence from a previous paper of mine with Victor Stango, that consumers seem to underestimate both the probability that they will overdraft in the future and the cost they will pay in the event that they overdraft. All right, so lots of cause for interest and concern here. On the other hand, to be fair, there's, I would say, a roughly equal amount of descriptive evidence suggesting that there may not be all that much to worry about here. Victor and I have found that low balances are very, very common among checking account holders in the US and rarely followed by overdrafts. So overdrafts conditional on reaching a low balance state in a given month are very much the exception, not the rule, at least in the data that we've been able to access. You know, some other data points here that I don't have time to get into, but another sort of compelling stylized fact is that the bulk of overdraft costs seem to be paid by relatively few overdrafters. All right, raising a related question, which is how much does experience lead to unshrouding and to a bounding of any distortions that a shrouded equilibrium might create? And we'll actually have something to say about that in our context. All right, so what we do, we worked with one of the largest commercial banks in Turkey. The bank was doing a direct marketing campaign to promote its overdraft products. It's doing so through text messages. This makes a lot of sense because Turkey is a hotbed of mobile banking and retail banking innovation more broadly, and 91% of Turkish adults have a cell phone. All right, so we did this at the tail end of 2002. The product at the time was very much standard issue for the Turkish overdraft market, less expensive than we see here in the US and have seen in the UK, but some common institutional features in the sense of little upfront marketing disclosure in that market. Post customer acquisition, we do tend to see a bit more activity in Turkey in the sense that this sort of promotion that we're evaluating here that the bank did is actually not uncommon in Turkey, where having acquired a customer, banks in Turkey often will advertise the overdraft product to their customer base. All right, so this experiment was, the marketing was sent to 108,000 existing customers of this bank, none of whom had overdrafted recently in the 3 months prior to the experience. And overall, this is a sample of people who had not been overdrafting much in the relative to the rest of the bank's customers in the year prior to the experiment. This made sense from the bank's perspective in the sense that it was trying to, it was interested in attracting more overdraft use on the margin. All right, so it didn't want to market to folks who would otherwise be overdrafting anyway. And you'll see why, because the bank was putting substantial incentives on the table. All right, so the bank sent all its messages. Everything was randomized. Everything sent by text message. The bank was careful at our urging to not do any other marketing to these customers during the 3-month period that it was conducting the experiment. Customers assigned to a direct marketing message got the same messages throughout the duration of the 2 or 3 month campaign. All right, I will not take you through this. This is the design in all its glory. We did a lot of things here. I'm going to focus in on the key ones. Oh, that's unfortunate. Okay, so the first key thing we're going after here is whether firms have incentives to shroud the price of overdrafts, right? Keep those prices hidden versus unshroud, all right? And so the way we're going to test this is to see what happens when the bank does advertising that actually draws attention to the price. Right. Again, we rarely see this, at least at the customer acquisition stage. And so about half of the sample here was offered a big discount. If you use your overdraft, you get half off, 50% off finance charges. All right, and so what I was going to have here is I was going to elicit your priors and then do fly-ins on the different possibilities. All right, so this could increase demand in any standard, in almost any economic model. We'd expect that cutting the price of something by half would increase demand, perhaps sharply. Maybe people aren't paying attention to the messages, in which case it wouldn't have any effect. What we actually found is that these messages decrease demand. Right? So offering a discount on bank overdrafts decreased usage of this product, and also we do some analysis to show that this was not offset by other revenue sources. So this was profit decreasing for the bank. Okay. Very consistent with what I understand to be the key prediction of shrouding models, which is that you don't have incentives to unshroud. There is not a profitable deviation. You go out and start advertising price, even saying, hey, everyone else is hiding their price, those prices are really expensive, we're going to offer you a better deal. It gets people thinking about price in ways that are unprofitable to you, and hopefully I'll have time to say a bit more about that. All right, so that's the first key finding. Do we think we really induced upward sloping demand here? I mean, it's sort of like seeing a unicorn in economics. We don't usually expect to see this. No, as I just intimated, what we think is going on here is by advertising the price, the bank is not just changing the price, it's bringing something that was not on the consumer's mind to mind. And it's consistent with a key assumption of the shrouding models, which is that going into this thing, consumers are probably underestimating the cost of overdraft. Right? Now, it turns out this bank is not just inept at doing price promotions. When they discount debit card usage or bill payment, we find evidence that people actually do those things more, so standard demand curves. All right, second key test. The bank also sent some people just these reminders. Hey, remember, you have this overdraft line of credit available to you. It's available when you need it. These messages actually increase demand. Not necessarily tightly consistent with the shrouding models I've been talking about, but we think consistent with some interaction between limited memory and limited attention that Andre Schleifer and co-authors have been working on lately. Third key test, and related to that, is we follow behavior post-experiment. So once the messages stop, what happens? Does the demand-depressing effect of drawing attention to prices persist? Does the demand-inducing effect of drawing attention to the availability of this product and reminding people persist? The answer to both of those questions are no. So we do not find any evidence of habit formation. All right, and we think this is, again, we think this is consistent with an important interaction between limited attention and limited memory. All right, so just to recap, advertising price, drawing attention to price, even if you're offering a really good deal, reduces demand for overdrafts. Reminding people that this product is there increases usage of overdraft. All right, this suggests that both price and perhaps other features of this add-on product are not at top of mind for consumers. And it also suggests, I think most critically for policy, that banks may well lack incentives to compete on price or to do anything that draws attention to the costs of overdrafting. Thanks.
All right. Next, we have Andrew Kaplan, who's Silver Professor of Economics at New York University. He's going to tell us about long-term care insurance, annuities, and the underinsurance puzzle.
So I, as other speakers, want to congratulate the institution and maybe Chris in particular for putting together an amazing conference. The trouble is that I've now got to break to another completely different subject, and I have no idea how much mental flexibility the audience has left. So try, okay? This is just nothing to do with anything you've heard, but nevertheless is part of this large field. Okay, so what we're thinking about is a new market. Abstractly, there's something that could be improved in the world. In particular, we're thinking of the long-term care insurance market, which potentially could be rather important. Everything in recent research suggests that if this market were to be improved, many things would go better. So we're going to ask ourselves the question of, given that the market right now isn't all that good, how much interest would there be in improved products? That's our question. When I say our, I mean my co-authors and I, who don't seem to be mentioned here, but they are Joe Briggs, Matthew Shapiro, John Amrichs, Chris Tonetti. I think I did it. So it's actually awkward not being able to see my own slides. Let me see what I said here. Okay, that's what we're talking about. So we're going to talk about a market, long-term care insurance, in which currently there are escalating. So why is it such a bad market? Well, what goes on is that you go in and you start doing research in the area of what worries me about my later life. I started doing this under John Amrichs. John Amrichs indicated that there were two mysteries that needed to be thought about very seriously in the life cycle model. One of them, which is why a lot of people don't save, and the other one, which is why all the people who do save, when they ultimately retire, don't spend. And he thought that was kind of an interesting second part of the puzzle that we hadn't thought enough about. And so that's been studied now increasingly, and it's become clear that one of the explanations that it must be on the table runs through the risks of high long-term care expenses. As they get studied, they look more and more horrific. As you think about it, and as I did research on this subject, I said, actually, that's one of the few things that could threaten me. So I kind of went and I started investigating the market, and everybody cracked up laughing. What do you mean long-term care insurance? You buy a contract, you then enter negotiation when you're senile for whether or not this is really a long-term care expense. And you're like, I don't know, I don't feel too smart right now. Well, then you can't make the claim right. So it's very hard even to classify what long-term care insurance is. It's a promise that certain expenses will get repaid, provided you keep with the premiums, which can rise unpredictably over time. So there's many ways for the company to cancel your long-term care insurance product, implicitly one of which is to raise the fee. So now we have a market which doesn't exist, and we'd like to know, if it did exist, what would happen. And I want to raise that as a point of method and a methodological challenge as you look forward. And in this way, I'm talking to the researchers as much as anything. How do we investigate demand for a product if we don't believe the evidence in the marketplace is dispositive of how good it could be? All right. So I'm going to show you a couple of different ways of doing that. And in looking at them, they will both be survey-based. And I'm going to claim that we need more than one attempt to skin the cat. And from the several attempts to skin the cat, we're going to find out both something about long-term care insurance and something about us as economists and us as thinkers, which is we're missing something. So the bottom line is going to be we're missing something. That's one part of the bottom line. Okay. So there's a model-based way of thinking, and in this model-based way of thinking, what you do is you first build a nice big structural model of late-in-life spending. You think about all the risks that you face in that phase. You think about the expenses you might face in that phase. You have utility functions. You have a model of beliefs. You have a model of everything. You then have a few free parameters that you fit. The data reveal what the parameters are. You then go simulate demand. We've done that in exactly the right kosher way inside a wonderful data set, which is the Vanguard Research Initiative data set that Vanguard has put together and allowed Michigan and NYU to join with it and put together a panel of this stage, about 5,000 of its upper middle wealth savers. So these are people who will have arrived at about age 55, and on average, they have roughly $1 million in total assets. So our first thing was finding out this is a group, a significant group, that can, in fact, choose how fast to spend down, and we can find out from them, maybe, why they're not spending down. So one of the first findings is that if you look, we've done fitting the data, fitting their behavioral data, and asking some questions. And if you ask questions about priorities. And no matter which way you do it, we find out that if you have to divide a story and say, is it bequest motives that are making people hang on to their money late? It's bequest to do with the family. Is it precautionary motives associated with long-term care? It's just a fundamental question. Why might somebody with, let's say, $1 million think that they should hang on to that and not spend it down? Well, because they want to give it to their kids, the first thing after they're dead, or they want to spend it on long-term care, the last thing before they're dead. Unfortunately, the two things, whichever one you were saving it for, it gets used for the other if you need it. So you can either have a mistaken, an accidental bequest. That is, I really wanted to save this for my long-term care, but it turns out I didn't need it, and it became a bequest. Or you can have accidental long-term care, which is you're saving it for the bequest. Unfortunately, you had a long-term care problem, and that wiped out the bequest. We did a study and asked questions looking at these two pictures, which tell you that there are potentially very high long-term care costs. If you look at one of them, I think one of them is telling you about a home health aide, and I think the other one is telling you about costs around the country for a private room for long-term care, 1 year, $200,000, depending on where you live in the country. And now we've got a couple, and now we've got some real issues for amount of money that might be needed to handle this single risk. And what we're going to do is to try and measure motives, and I'm going to explain to you how we use questions to get inside the head. This is our goal. We're going to use survey methods to get inside the head because we believe that in a non-existent product, it's hard to use demand data to work out exactly how much you'd like to buy it. There's no evidence out there. So we're going to get inside the head thinking that people themselves understand a little bit about what they're doing. And I believe this says we describe a hypothetical environment, describe a hypothetical state of the world, describe a hypothetical future, hypothetical choice set, verify understanding, and record a choice. We have a very bright crew. They put real time in to answering the surveys we designed for them. It would take about an hour. These are pretty wealthy people. They've been seduced into sharing their biographies with us, which is the way we think this kind of a conversation. They're perfectly happy telling us about themselves. And they're going to share that aspect that says, what would you do? These are tough questions. There's a health warning that comes at the beginning of the survey. If you don't like considering unpleasant contingencies, please don't take this survey. It says, you're 85 years old, live alone, rent your home, pay all your own bills, and I'm going to give you a choice split money up between two plans. One of them is basically an irrevocable bequest, and the other one is to spend on your own private long-term care. Couldn't plunge more directly into the trade-off than to ask about the trade-off. And we think that people have some vision of what they would do in this trade-off. And we then go through, I have to dash. We then go through a detailing of this scenario. We then test them on understanding of the scenario. In other words, these are people who we verify they know what we just asked them. They may think we're crazy for asking it, but somewhat they think that it might be about something they care about. We gave them a wonderful custom-designed slider which had no dot placed on it initially, and as they decided what they wanted to allocate to one resource or the other, they moved it and they got to see the implications for their choices. So it's a quite conscious way, we think, of helping people make choices. We got a lot of evidence that they understood and responded to changes in the question in an intelligent way, and there are general consistency checks for the meaningfulness of their answers. You're looking for any correlated activity that would say, look, this is a numerical version of common sense. We've found from other data that some of them have a will, some of them don't. They have kids or they don't. We've given them a numerical way of expressing a priority. So we do that, and then we actually simulate demand. Now, for each individual, I want to make a point, which is that these questions, we can pose so many of them of each individual that we can, in principle, identify each individual's own parameters. We find their preference as between, let's say, bequests and long-term care at the individual level. We then, for each one of them, identify how much of this insurance they should buy. You won't be able to read the labels. I just want to kind of show you that we've done it. We've simulated demand. Now, you have to understand that when you simulate demand, you're simulating demand for the model product. That is, you're saying, okay, we're going to describe a product in our model that's perfect. It's not this awful, we can't model the process of making a claim. We just model something that delivers money for you when you need help with the activities of daily living. That's the model asset. It's not the real asset. So that's what we're trying to. On the other hand, we can ask people directly, okay, let's offer you this model asset. No model will intervene. We're just going to go up to them and say, by the way, I've got an offer for you. It's a wonderful form of long-term care insurance. We're not going to call it long-term care insurance. We're going to call it activities of daily living insurance. And we're going to offer it to you in this survey. We're going to say, how much of this wonderful product would you like? And I'm going to test you to see that you understood that this is not classical long-term care insurance. This is just a delivery of resources to the state in which you need to spend money on care. So we're going to ask you, and I'm not going to read this, but I'm going to point out to you that, again, we tested people on their understanding of this product, and we asked them how much they would like to buy it. So now we have two different ways of getting demand for the same product. One of them, we built a model, estimated parameters, got demand. The other one, we asked for the same product. Now, if our models were perfect, this would be the same number. What happens instead is that while there is tremendous interest in long-term care insurance, it's much lower than what we found from the model. Much lower. Now, maybe that's because they didn't understand anything we said. It was all like a whacked-out product. Well, we did the same thing for annuities. So this, by the way, just shows you there's a big difference. For annuities, the difference is stunning and dramatic between what a model says they would like to buy and what they say they would like to buy. Our model says they should be buying annuities. It's strange that it says it. We built our model, tried to see if we could get rid of, drive a stake through the heart of the annuity. We couldn't. In our model, they should be buying annuities. When you ask them, are you going to buy annuities, they say, not on your life. Wouldn't touch them. Okay. In fact, some people avoided the survey when they found out annuities were coming in. Okay, so why might that be? What our theory was, and we did have a theory, that if there was an error, it might be because the bequest motive is being rather cavalierly treated in classical models. The bequest motive is a motive to give money when you're dead. Literally, it's a motive to give money when you're dead. But people transfer money too when they're alive. In fact, they might think that's rather more important to keep money for when you're alive. Our 85-year-old was kind of considering one more year of life, but what have they done in the meantime? So we have 3 measures of intergenerational transfers, and I can tell you the bottom line is that the higher are the observed transfers, the more we understand the gap between these 2 different measures of demand. So what's happening is we're getting a strong hint that current models are misspecified in understating transfer motives. That's a model point. So I want you to take the 2 things out of this. First off, yes, there would be demand for long-term care insurance. Second, it's not exactly what you think it would be from a model. It's probably not exactly what you think it would be from an answer to a stated preference question. It might be somewhere in the middle. But in the meantime, you can learn to improve your model building, and maybe next time the answer will be more accurate. Thank you.
To discuss these papers, we have Ava Najipal, my colleague at the CFPB.
Thank you very much. It's a pleasure to be here. These are 4 amazing papers to read. I really enjoyed reading them. And as a testament to that, it was just really thought-provoking. So I'm going to be entering the speed talking contest that's been going on. In a second. Nope. All right. So essentially, all of these 4 papers address demand for a particular consumer financial product. That's sort of a common theme they have together, but they're actually very different in different dimensions. So particular duration is, very different between check cashing and mortgages. The population served is very different. You go from, low-income families or low-income individuals in the Southern Bronx to relatively wealthy individuals in the Vanguard sample. Also, the products that we're considering are different. But one theme that's common is that of information. So I'm going to be trying to take that tack and bring that to all 4 of those papers, hopefully. Within information, there's sort of various aspects you can think about. Do consumers know? What are their beliefs about the future? Is there any learning or updating taking place? And what is the specific context that might be influencing their decisions? So the first paper we heard about was about check cashing. And here the authors have a very nice and unique data set looking at the check cashing in the South Bronx. I must admit I wasn't convinced that the Logit model was actually appropriate here. Because in Logit, what we want to see is a set of consumers and all the choices that they've made, all the outcomes. In this particular case, we only see checks cashed at this particular outlet. So the authors kind of recognize it and create these counterfactual zeros, because you need zeros in a logic model, sort of recognizing that the people who showed up after the price cut must have been cashing some checks before, but there are other checks that are being cashed by this set of consumers, presumably. So we don't know for certain whether that's not the case. So I just never quite bought that modeling choice. And there's something in the results that kind of shows you that there might be something going on, which is that the elasticity they estimate from the Logit model is close to 6, But if you actually calculate the elasticity from sort of the raw summary stats, which you can do in this case because there's very compelling reasons to believe that really what you see is a demand shift in response to a somewhat exogenous price change, then the elasticity is about a half. Because we've seen that the fees go down fourfold, and number of checks guys go up double. So sort of your undergrad, you would chide them for this for doing this, but they calculate the elasticity's got to be 1/2. So maybe a different model would be appropriate. Another issue that one wants to take into account here is that there's very strong time series variation in the number of checks that are being cashed overall, because checks are just going out of use. So for example, for this population, we know that government benefit checks have actually gone electronic. So they've gone to prepaid cards for some of them. So it would be kind of useful to take that into account, especially since the price variation that we are using is time series variation. Okay, so that's one point worth considering. Now, the nice thing about this data and this setup is that you can actually do something very simple. Okay, you can just, you can even just run OLS. You don't need even a logit. You could estimate daily demand for checks cashed at this particular bank as a function of price. And to the extent that we know that supply is essentially inelastic because we have a cap, and I've totally bought the argument that the price changes at the Spring Bank were not really driven by some profit maximization motive. They were essentially could be treated as exogenous. Then we could just trace out the demand curve. And then we could think, then we could throw things in like, some sort of time trend or indicators of when certain types of checks went electronic. We could throw things like days to clear. We could have day of the month. So here I think it would be very interesting to look at whether we could identify individuals with paychecks. So are these like working poor individuals, or people who get government benefit checks, which themselves come on a regular schedule. So I think there's a lot of things you could get out of sort of a simpler setup. The second part that was actually, I thought was, sort of grabbed my attention more. Here you're looking at people who have an account at Spring Bank and looking at their decision whether to deposit a check or to cash a check. And the variation you're going to have is the number of days that this check is going to take to clear. And you can estimate some sort of a discount rate from that. So if it takes me 3 days to clear, I'm going to be much more likely to be cashing my check than if it takes 1 day to clear. Here again, it would be very useful to look at, to use the fact that this is actually panel data. You observe the same individual over time. So is it that sometimes they cash the check on a Friday, some other Friday they deposit it? Is there sort of variation in their liquidity? How do we think about this? Do we really want to annualize this up into some APR, which is implied to be 500%? It's a discount rate, which is sort of problematic because it implies exponentiality and sort of also implies that this is somehow time discounting as opposed to liquidity. I think there's a lot of interesting things here. We could also differentiate this by source of income. So are government benefit recipients different than those who are actually working? And in terms of the information, I think it would be useful to look at how information about prices actually gets dispersed. Is it geographically? You learn from your from your neighbor that, oh, hey, Spring Bank cut its prices, go there to cash your checks from now. They have the data to look at that. Do you learn from people in similar situation, like other government check recipients? So I think there's a lot of interesting things to do here. The authors are on the right path. For the mistakes in the mortgage market, I think this really nicely ties into the discussion of optimal versus actual that we've been having all through this conference. I guess my one overarching comment would be a word of caution to call everything that's a mistake, that's a difference between our model versus the actual behavior. So in particular, in this case, in authors say, well, we're going to construct what's your estimated time that you're going to spend in this home. Let's say that's 5 years. And then compare it to the amount of time you would need to break even on your points. Let's say that's 6 years. And then if the 5 years is less, well, you made a mistake. Well, maybe that's based on the information that the econometrician has, and maybe I really actually expect initially to be in that home for 8 years, and then my point decision would be optimal. One way to get at this is to look at whether the prediction error from the econometric model is actually correlated with points taking. So where the econometrician thinks you're making a mistake, are you staying there longer and taking points? Also, one question we sort of are very often faced at the Bureau with sort of really understanding institutional details and the actual circumstances and context in which decisions are made. How much do we know that these people actually had a choice to do something different than what they did? How much do we know that they had access to points, they had access to the rate sheets that is sort of being assumed? And now the authors talk to this point. They include bank fixed effects, but I'm just not convinced that that really fully captures this issue. In terms of the sunk cost example or sunk cost result, again, I'm kind of concerned about calling everything a mistake where there's a difference between our models versus actual behavior, because you could imagine that there's a family who has a particularly high private cost of tracking mortgage rates. They have 4 dogs, 3 kids, 2 jobs, and the works. And so they're going to be the ones who say, well, I know I'm not going to refinance in the future, so it's likely that I'm going to be taking points now because it's just more useful to me in doing that. That kind of model is going to lead to the exact same conclusion that people who take points are less likely to refinance, which they call a sunk cost mistake. Now, for the overdraft paper, I really enjoyed this, especially since I'm the lead economist in the overdraft team at the Bureau. I don't know how I'm going to be taking this to my job directly, because the sort of applicability to how overdraft in the US is limited by 2 things. One is that this is really overdraft line of credit. So, since just 60% APR overdraft line of credit. In the US, the overdraft that we're most concerned about is courtesy overdraft, where you take out usually there's a debit card transaction, which median size is $24. You pay a $35 fee, and on average, 3 days, you pay it back. Now, I'm not a big proponent of calculating an APR based on those numbers, but I haven't been able to convince everyone about that in the Bureau. So there is an APR number that goes with that, which is actually 17,000%. So that's a very different type of product than the product that's here. In addition, as Jonathan pointed out, these are actually not heavy overdrafters. So this was, naturally, given the incentives of the bank, were selected to be account holders who don't overdraft so much. The 2 things that pops out about this paper. So it's very clean. It's really beautiful. It's an RCT in a real-world environment. We already heard about it yesterday, so you can't say enough great things about it. So the 2 things is that I'm still not quite understanding how this sample went from overdrafting 18% of them overdrafting over 8 months to over 30% of them overdrafting in the 3.5-month period of the experiment. So something like there had happened that's just simple mean reversion is not going to explain it, at least in my opinion. So it would be very nice to understand what was the dynamics. I try to look at what happened in the Turkish consumer finance market. Is there something that I'm not aware of? But I couldn't find anything. The other thing was that there was no clear control group in the sense that essentially you had different treatment arms, but there was no group to whom nothing happened. And the justification for that was that it never happens to customers that they don't get any message from their bank. I guess I would have liked to see some control group constructed that gets some sort of basic messaging, like this is, your balances or whatever your common messages you get at this particular bank. It just would have been easier to compare the treatment effects as opposed to in this way, which is like a group of treatment groups compared to another group. Okay, I'll skip the last part. And finally, I actually really loved the last paper. I thought it was just a beautiful combination of the best use of survey with structural models. I really encourage everybody to read it. And the fact that they can actually elicit these individual preference parameters was just amazing. It's really impressive. Now, the authors identify what they call an underinsurance puzzle. I personally would have been puzzled if the model actually fits the stated demand. So, it's just a different perspective. And I think there's a lot of reasons to think why the model, why stated demand would be lower. One of them is that while they were very careful to kind of have people not think about long-term care insurance and annuities, I don't know how much these people actually in the survey thought about long-term care annuities, and these are products with very bad reputation. Secondly, demand does not arise necessarily in hypothetical situations. Demand arises in context and because you talk to other people who take products and so on. I know my husband told me the other day to get flood insurance, and my first response was like, do our neighbors have flood insurance? So you get these things because other people have it, and you kind of like update your thinking about these products. So finally, these strategic survey questions I thought were very abstract. So I particularly got hung up on the one where you know for sure that you're going to die in 12 months. That's sort of a situation where we just don't get into that. So I thought that there are lots of reasons to think there would be a difference between the stated and the modeled demand, and I wasn't so concerned about the difference. So maybe we need to be less demanding of the model and just say, if the model overpredicts demand by a factor of 2 for everybody, then actually it's a pretty good model because we can sort of adjust to saying, well, we know there are these other factors, and we just need to kind of shave off our projections. So I would like sort of push more for a relative interpretation as opposed to an absolute level interpretation. And also, if we actually, these relative demands line up, then that to me is an even better just like verification of the strategic survey questions than the internal coherence, because I think internal coherence is something that people aim for even though it might not have anything to do with their actual preferences. I know that when I answer questions, I want to be coherent because I don't want to look incoherent, but nonetheless, it might not have actually to do anything with my preferences. Thank you very much. Great papers.
Whoops. So I think we don't have time for questions since it is already noon and the event that our speaker wants to get to is due to happen soon. But let me remind everyone, John Campbell will be giving the lunch talk starting at 1:30. And if you do go out, make sure you leave time to get back in through security for John's paper. The lunch, I think the box lunch will be here at 12:30. So I will see you all certainly in time for John Campbell's talk.